Hi, I really hope you enjoy this educational video. My name is Mark Byelich. I'm a certified financial planner, and my team and I focus on developing tax-efficient or tax-free retirement strategies for our clients. We also focus on investment strategies that allow folks to eliminate the worry and have the potential growth that you need in retirement. So enjoy the video, and at the end, I'll tell you how you can schedule a no-cost, no-obligation consultation with me. Enjoy. I want to remind you all that you are muted. Q&A is available at the bottom of your screen. You click the Q&A button. You can push. You can type in your questions as we go. Please do. Your chat is disabled, and of course, we're being recorded. I hope you're seeing the recordings on the website. If you miss a weekly recording, you can always go to it. There is right now. We had to restructure the pages because they're getting so full. So every time we do that, it goes back through compliance review. So I think the most recent one is mid-October, but that should catch up pretty quickly in the next day or two. So I hope you're taking advantage of those. And one of the other things I'm going to do, if we have time today, is just talk about some of the educational resources on the webpage. So let's move on. Ed Slott updates. Now, this is a little bit, there's a great letter that came out, or article that came out from Andy Ives yesterday, and it ties right in with what we were talking about with the pros and cons of Roth IRAs. So I'm going to read through this. There are 12 points he makes, and you're going to hear some of these repeated, but these are all very good. And the title of the article is Clarifying Some Roth Conversion Misconceptions. So this is focusing on Roth conversions specifically. What I'm going to be talking about is Roth IRAs compared to traditional IRAs. I'm speaking specifically about Roth IRAs. I want you to remember that 401ks, retirement plans, 403bs, other retirement plans, and IRAs have completely different rules, and you have to treat them differently. Of course, they're similar. A deferred 401k, tax-deferred 401k, acts very much like a tax-deferred traditional IRA. A Roth 401k from a tax treatment acts very similarly to a Roth IRA, but the rules are very different. So today I'm going to focus on Roth IRAs, pros and cons. So Andy writes, as Roth IRA conversions become more popular, of course they're more popular. There's more of us out there talking about it. It's been 10 years for me. It was 2011, I think October 2011, when I first sat in that continuing education seminar that you're probably all tired of hearing about now with Ed Slott, and everything changed for me because I realized there's a whole world out there that I was missing for clients, and more people are getting on that bandwagon. I have a coaching call this coming Monday with a fella who just joined the Slott Group who's in Florida. And I'm always happy to have those calls with folks around the country. So that's a financial advisor in Florida who just joined the Slott Group. And from time to time, maybe half a dozen times a year, somebody will reach out like that, and I spend time with them. And that happens with a lot of the Power Zero, Changing World of Retirement people too. So as Roth IRA conversions become more popular, questions and misconceptions abound. Boy, isn't that the truth. I was on a call with somebody from the class who had a follow-up appointment with me, and he said, and he's talking about Roth conversions, and he said to me, well, there are a couple of things that he had confused, and it's one of those situations where a little bit of knowledge is dangerous, right? So this is clearly a person who knew some information, knows what he's talking about generally, but the devil is in the details, to use a cliche. And he said, well, I know I have to get this done by April 15th of next year, talking about a Roth conversion. And I said, no, that's not the case. You have to get it done, at least the IRA amount distributed for the Roth conversion by 12/31. And in my opinion, you want to have it all locked down and confirmed by 12/31. But the reality of that is this, just like we're experiencing now, most custodians, so that's Vanguard, Fidelity, Charles Schwab, whomever holds your money, produces your statements, UBS, any of them, they have different dates. Like ours for Fidelity, NFS, Castro, whatever you want to call it, is I think the 25th of November. So it's much sooner than the end of the year. And now what will happen is if they get a request for a conversion after that, they give it best efforts. But I'll tell you, Roth conversions are becoming more popular because people are starting to see more and more that, of course, tax rates have to increase significantly in the future. So you may not get that conversion done, and that stinks because you can't go back. Once that year is passed, I've seen this regret in people, and once that year is passed, you're done. All right. So there are a lot of those misconceptions. Be careful of the spotty kind of information that is out there, and you've got to have a conversation or work with somebody who is very, very knowledgeable about these things and practiced. In no particular order, here are a dozen Roth IRA conversion facts, issues, and mistakes to avoid. So I'm just going to read through them. Anyone with an IRA can do a Roth conversion. There are no income limits. I talk about this all the time. You can have zero earned income and do a Roth conversion. You can make $1 million and convert. So from zero to, $5 million a year or more, there's no income limit. Currently, you can do a Roth conversion. That is true. There's no limit on the amount that can be converted. If you have an IRA worth $3 million and want to convert the whole thing, you can. He says, go for it. I wouldn't say that. I would say that's a lot of tax to pay in 1 year. You should probably make sure before you do something like that there's not a better strategy, but you, of course, could. Inherited IRAs, beneficiary IRAs cannot be converted. People ask me that all the time. What about this $100,000 I inherited from my mother? How should we convert that? The answer is you cannot. It's not allowed. There is no penalty in a Roth conversion regardless of age. So even if you're 40 years old and you want to convert to a Roth IRA, you can do that. If you're 20 years old and you have a traditional IRA and you want to convert to a Roth IRA, you can. Understandably, IRA owners get a little gun shy when they complete any transaction before age 59 and a half. Rest assured that there is no 10% penalty on a Roth conversion, no matter how old you are. So you can convert that money, right, from a traditional IRA to a Roth IRA. There is no 10% penalty. Of course, you have to pay tax. Therein lies the question. He follows up with that on number 5. Beware, however, that if you are under 59 and a half and have taxes on the conversion withheld, paid from the IRA, you just shouldn't do that. There can be a 10% penalty on the amount withheld. The reason for that is the amount withheld. If you're under 59 and a half and you decide to withhold taxes on that conversion, that's considered a premature early distribution. And you can't do that under 59 and a half, except for some very limited circumstances. And you'll without a 10% penalty. So not only will you pay the tax on that, but you'll pay a 10% penalty. Doesn't make sense. Make sure you've got some funds on the side to pay for that. That's if you're under 59 and a half. Always better to pay tax for your conversions with non-tax deferred funds. So if you've had in the taxable bucket, you have, I talk to people with significant amounts of money in that taxable bucket. They can pay the tax on that conversion. That's where it should come from. If you have all of your money or the majority of your money in an IRA, it's still okay to do it, and you're over 59 and a half, it's still okay to do the conversion and withhold the tax. That's fine. We just, the math, the time that the conversion really excels, there is no break even. The time that that conversion really excels is a little longer. That's okay. You pay the okay, I talked about that. So number 6, speaking of taxes, they are not due immediately upon conversion. The amount of the Roth conversion is added to your income for the year. You can settle up with the IRS next April. I'm going to disagree with Andy on this. I wouldn't wait until April because some people are doing significant conversions for the first time and it's not factored into the taxes. Now, there is something in the IRS code that says at least if you paid at least what you paid in the year prior, you won't have any penalties. But if for everyone who's doing Roth conversions in this part of the year, the final quarter of the year, so the fourth quarter of the year, I recommend, always talk to your tax preparer, but I recommend you make that tax payment by January 15th to avoid any penalty. Don't wait until April. You just might have a few $100s in penalty. That's absolutely unnecessary. So partial conversions are allowed. Implementing a strategy of partial Roth conversion specific to your financial situation can help manage taxes and mitigate risk. So of course you can divide that up. If you have $1 million in your IRA and you want to divide it up $100,000 a year for the next 10 years, that might work for you. You don't have to do it all at once. A Roth conversion must be initiated by the end of the calendar year and probably before to qualify for that same tax year. The funds being converted must be withdrawn from the traditional IRA by year end. There is no such thing as a prior year conversion. Spot on, Andy. This is Andy, yeah. For IRA owners taking required minimum distributions, if they're older than 70 and a half under the prior rules, or 72 under the current rules, the RMD must be taken before any Roth conversion can be done. Yes, of course, that's a requirement. The RMD has to be distributed from that account or satisfied from another account before the Roth conversion can be done. Number 10, each Roth conversion will start its own 5-year clock, which must be satisfied. We're going to talk about the 5-year clock in a moment. Or you turn 59 and a half before the converted dollars can be withdrawn penalty-free. Once you have held any Roth IRA for 5 years and are 59 and a half or older, earnings on converted dollars can come out tax and penalty-free. Yes, 5-year clock can be very confusing. You're going to see a chart that we use that's supposed to make it less confusing, but it's kind of a crazy chart. So we'll talk a little bit more about that in a moment. 11, Roth IRAs have favorable ordering rules for distribution. We're going to talk about that too. It does not matter how many Roth IRAs you have, nor does it matter if you segregate your contributory Roth IRAs, for example, from your conversion Roth IRAs. Some people do that. They'll say, these are the ones I've contributed to. These are the ones I've converted. I want to keep them separate. Well, that doesn't matter. The IRS sees it as one big bucket of money. So under your name. So regardless of which IRA you take a distribution from, Roth ordering rules dictate that contributions come out first, then conversion dollars are second, then earnings last. This is why it's very difficult, unless you're really backed up against the wall, to trigger those 5-year rule penalties. So be careful. Roth conversions are added to adjusted gross income. This can impact stealth taxes on items like adjusted gross income, such as IRMA, income-related monthly adjustment amount, surcharges, financial aid, and taxability of Social Security. Very good point. We'll talk about that again, Andy. So I'm just looking up here because I do want to reference my chart, my tax charts in a moment. And I'm going to, if you want to follow along, I'm going to my website, outofourwealth.com, going to the Ed Slott corner, and I'm just pulling up the charts so I can share them with you. So this is a really interesting one, and I had a bit of a chat with Sarah about this early this morning. But RMD deadlines for those reaching 72 in 2021. So we have an interesting situation with a client. He turned 72 this year on July 9th. That date's important. And he is fighting taking his first required minimum distribution. He just does not want to pay that tax. He doesn't want these funds distributed. He's very, very, I don't want to say stubborn, but that's what comes to my mind. But he does not, he wants to wait until April 1st of next year, his required beginning date for him, to take that distribution, knowing that he's going to have to take 2 next year. So he and I and his accountant have talked about this several times. We're both recommending that he takes one this year, but I don't think that's going to happen. But he's lucky he has a choice by 8 days. So let me explain to you what I'm talking about. Any IRA owner, Sarah writes, this is from Sarah Brenner, any IRA owner turning 72 this year will have a required minimum distribution due for 2021. But depending on when they celebrate their 72nd birthday, the deadline for taking the 2021 RMD may be different. This is a crazy thing that just occurs this year. Why are IRA owners who reach 72 in the same year treated differently? There's a strange quirk in the rules that are product of both the Secure Act and the CARES Act. The Secure Act changed the age when RMDs must begin from 70 and a half to 72. You probably remember that. The CARES Act eliminated any RMD in 2020. As a result of these 2 recent laws, we can divide RMD owners who reach 72 in 2021 into 2 different groups with 2 different 2021 RMD deadlines. That is, if you reach 72 prior to July 1st, you have to take your deadline. Your required beginning date is prior to December 31st, 2021. You have to take it. If you turn 72 after July 1st, 2021, well, you have until April 1st, 2022. So if you turned 72 on June 30th and you're being a little steadfast, let's just say, instead of stubborn, if you're being a little steadfast about waiting until April 1st, don't, because you are going to miss your required minimum distribution and you'll face that 50% penalty. So don't mess around with that. The good news is that in all this RMD confusion is that after 2021, all IRA owners and reaching age 72 will fall under the Secure Act, and the transition to age 72 will be complete. The dreaded 1.5 year RMD confusion that has tormented seniors for decades will come to an end. So that was interesting, Sarah. Thank you. All right, one more slot. This is from the mailbag. I hope you find these interesting because boy, I do. This is a good one. So this is from Ian, or Ian. Ian likes to go by Ian. Hello, I have a question about the calculation for RMDs when they were missed for multiple years. Here's a person who missed RMDs for multiple years. Is the RMD calculated on the actual balance or the balance that would have been if the RMDs had been taken? Thank you. And her name is Jill. Jill's in a boatload of frustration and potential cost, right? So she missed her RMDs for several years. Now she has to go back and take the RMDs and potentially pay that penalty on each one of those years, which is 50%. Now I want you to remember that penalty as we go into the next question too. So good question, Ian writes. The IRS says that you must use the actual prior year-end account balances. In other words, you can't subtract out the missed RMDs from those previous account balances. What Jill was saying was, hey, if I had to take a $100,000 RMD, wouldn't I subtract that amount of what I should have taken from the year-end balance? And the rule is no. You're kind of getting hit twice, right? You have to use the actual year-end balances of those accounts. So next question, in 2022, I have a $70,000 RMD requirement, this person writes. So think about that. If you have a $70,000 RMD requirement, and what if you missed that for 3 years? Folks, that's a lot of money, and 50% on each one of those RMD requirements. So $35,000 a year times 3 in that case. Woo, those big penalties. I was planning on doing a QCD, a qualified charitable distribution, a really valuable tool that we've been using with clients, $50,000 and a $20,000. So QCD for $50,000 of the 70, and a $20,000 distribution to account for the $70,000 requirement. Later in the year, I want to do a $50,000 Roth conversion. Can I do the QCD and the RMD distribution at the same time, and then later in the year do the Roth? Does their Roth conversion, that is. Does there need to be a time delay between the QCD first and the RMD disbursement, or can they be done at the exact same time? So Ian writes, yes, you can do the QCD and the RMD distribution at the same time, and then later in the year do the Roth. However, to avoid any possible confusion, you may want to complete the QCD transaction before having the remaining RMD paid. Good advice. With regard to the Roth conversion, there is no reason you can't do that later in the same year after the full RMD is satisfied. So that's very good. I think it's good to stage it like that, take care of that QCD, so you make sure that that is confirmed properly by the charity who's receiving that distribution, and then take care of your RMD, and then you can do your Roth at any time as long as you get it done by the end of the year. As we discussed, any Roth done at any time throughout the year is considered done as of the first of the year, really, as long as it's done. All right, so going into markets quickly. Let me just check to see if there's any questions on any of that. No, good. We got a full house today, folks. Got a lot of new people. Welcome to all the new people joining us for the first time. I welcome feedback. I hope you enjoy this. So the Dow Jones Industrial Average this past week, very strong week again, was up 1.43%. The S&P 500 was up over just 2%. The NASDAQ was up over 3.08%. Strong U.S. markets. Global markets were strong as well, with the exception of emerging markets, which was down 0.04%, just down slightly. So bonds are up. The aggregate bond index was up slightly, but still down for the year, 0.95%. So bonds have, in totality, right? What we generally use is the bond index is down 1%, just about. So this is what I'm always talking about. People want to put their money into bonds for safety, and we're having a great year in the stock markets this year, and the bond markets are, while the ranges go down from 0.95% to down 7.54%. So bonds can drop very, very quickly and very, very deeply. So be careful with those bond allocations. Speaking of bonds, the 10-year Treasury was down again this week. Last week it was 1.55%. It was down 1.45%. How about a year ago? A year ago, we sat at a 0.76% 10-year treasury. Unbelievable, but still very, very low. All right, let's talk about some analyst reports. We have BlackRock, one of my favorites. So they talk about climate risk, and climate risk is investment risk, they say. The global net zero transition will help shape portfolio outcomes over coming years, with emerging markets playing a key role. So we're just talking about the emerging markets, the smaller economies throughout the country, or the globe, excuse me. And obviously, there's a lot of talk about EVs, right? Electric vehicles, especially with this stimulus package or this infrastructure package that has credits again for EV cars and charging stations and all that. I'm a big fan of this space. This is not a recommendation. I've been a fan of Teslas for a long time. When we had our office in Langhorne, I'm not suggesting you buy or sell Tesla. This is not any kind of recommendation. I'm simply giving an example. We had, when we had our office in Langhorne, there was a restaurant around the corner called, Byelich. And we had Tesla come out, and they brought 3 cars, and they did a demonstration with the cars, and everybody there got to do a test drive, and it was fantastic. And I've been a big fan of Tesla really since. So they've just really led the market. There's a lot of other companies out there doing it. Excuse me, just 1 second here, folks. Okay, I had to hit my sneeze button. I'm so sorry. Okay, but a lot of movement towards the EV market. So that's really going to be interesting to see how that shakes out, especially as gas prices increase. The Federal Reserve, how about the market backdrop? The Federal Reserve plans to start tapering its bond purchases. We talked about this a couple months ago. What is tapering? The Fed stops issuing and the government stops issuing. The Fed stops buying bonds, slowing it down. They plan to start tapering its bond purchases in November, and said the current high inflation will unlikely require a fast rise in rates. So that's interesting. So what they're basically saying, because inflation is so high, it's unlikely to see a fast rise in rates. And in the week ahead, they say data from China will be in focus. We see easing in monetary, fiscal, and regulatory policies after a broad tightening has softened growth momentum. So China has kind of switched from a market capital, more what's the word I'm thinking of? A free kind of market to now a state-controlled market again, and they're seeing that it's slowing growth. So they're saying BlackRock is saying we may see an easing in monetary, fiscal, and regulatory policies from China. All right, Riverfront. This time, Riverfront has a really interesting take on inflation. We've been talking about inflation now for, since June, July, and 2020. Talking about the risk of rising inflation. BlackRock is really the first one out there on that, and we're living in it right now, aren't we? Everybody's worried about it. We know that the year-over-year inflation rate, and just this past month from the consumer price index that we get from the Bureau of Labor Statistics was 5.4%. We all know that Social Security is going up 5.9% last year. I don't think I've ever seen it that high in my lifetime. Huge numbers. I did a barbecue for a bunch of friends over the weekend. I cooked a 15-pound brisket, and I was shocked at how much that brisket cost compared to how much it's cost in the past. So, we're seeing these things all over the place. Gas prices, groceries, availability of things, it's starting to be a real problem for people, and it concerns folks, especially if you're retiring, because if you say, I need to spend $10,000 a month, $120,000 a year. Well, you're basing that on what you're spending today, and we've been in a very low inflation environment for a long period of time. It's probably been 12 to 15 years. My memory's telling me. Someone might say, no, it's only been 11 years, and that's fine. If you have that data, share it with me. Happy to be corrected. But let's say that's a long period of time. Most of us have a hard time thinking past really 5 years, right? We remember how things have been for the last 5 years. You go much past that, you forget how things were, unless it has a huge impact. a significant loss of funds or ability to do things, but just day to day, you kind of forget how those things work or how they affected you. But, we've been in a very low inflation environment. It's been relatively easy to gain access to capital, right? Funds, lending, mortgages, everything's been really relatively cheap. And that's likely to change and continue to change. And now we're seeing these things that can be very frightening as you're going into retirement, because don't forget there's math and monetary availability and investments in retirement. But most importantly is how you feel about things and the psychology behind things. And when we're fearful, we tend to get protected. And the concern about being protected, in your investments and in your growth and your ability to have some level of comfort with, taking some risks in investments to achieve returns, is that when you tighten up like that, if inflation continues, even at a reasonable rate, 2.5%, 3%, you may struggle unless you have a significant amount of money and you spend a modest amount of money. You may struggle with keeping up with things in the future. We've seen inflation rates of 5% to 8% for things like healthcare costs and college costs, and we know how quickly they've gotten out of hand. So if the world lives in that 5% for several years, it's going to be challenging. Riverfront says, don't worry about that. And I'm going to share with you why they say that. So these key takeaways from their report include third quarter or earnings season has reinforced our belief in the strength of corporate America's recovery. Okay, I like that. That's optimistic. I believe inflation is closer to the Fed's long-term objective than the headline numbers suggest. We're going to dig into that a little bit. And the third one was recent non-farm payroll numbers suggest to us help is on the way for supply chain bottlenecks. So all very positive. I like that. Well, let's talk about this. The belief in that inflation is closer to the Fed's long-term objective than the headline numbers suggest. So the headline numbers are 5.4%, right? Year over year, 5.4%. So let's see. I'm trying just not to lose. I'm trying to lose some of the jargon. All right. So they start with prospects of rising inflation combined with policy changes at the Federal Reserve and the waning effects of pandemic-related stimulus leads to questions around the implications of U.S. economic growth. When it comes to inflation, it's important to determine what is high and what is acceptable. From the market's perspective, the Fed's view is most important since they control monetary policy. The Fed, very simply, is in charge of interest rates and inflation. That's what they're trying to balance. They have stated that inflation of 2% over the longer run is consistent with their mandate for maximum employment and price stability. Further, the Federal Open Markets Committee has stated that when inflation has been running below 2%, monetary policy will try to achieve inflation modestly above that target for some time. That's where we've been for the last several years, is below 2%. So where do we stand with the respect of inflation? The headline number stood at 5.4% year over year at the end of September. These are the last numbers we have. However, looking at inflation through a different lens, that strips out some of the more volatile elements, reveals that inflation is actually closer to the Fed's target than what you would see scrolling across your television screen. And these television stations, we talk about the 24-hour news cycle. They're always trying to get people to pay attention. Then they reference a chart. So below is a chart showing the Fed's trimmed mean inflation rate, which stands at 2.3% as of September 30th, 2020, well within their acceptable range. The trim mean is designed to reduce the short-term influence of more volatile constituents of the report, so the volatile parts of the report currently driving headline inflation. So energy, I would say, meats, things, certainly building supplies. I'll share with you that building supplies have come down significantly. Many of you know that we're in the middle of renovations at our office. The quote that we got for lumber and supplies in April was significantly higher than what we just received from the supply company. So while I've been frustrated by the delay, it saved me some significant funds. So that's always good. So hopefully as we speak, my roof is being ripped off the building. that will be taken care of this week. But that's an example of the more volatile areas. So what they're saying is when you trim out some of those volatile areas, then it's more, the inflation rate is more in line at 2.3. So that's encouraging. I appreciate that information from Riverfront. Okay, so now let's talk about, and I think that's everything for the markets. Oh, I'll give you some from Prudential. They were just now we can skip that. That's fine. Let's jump into pros and cons of Roth IRAs. So I'm going to share my whiteboard with you all. Let me check, see if there's questions first. No questions. Okay. You should see my whiteboard here, and you'll see financial planning topic, pros and cons of Roth IRAs. Please raise your hand for me if that's what you see. Thank you, everyone. Again, for those of you who are new today, joining us from the class, if you see me looking around, it's because, like many of you, I have 3 monitors I'm working with. So I have this one where my notes are that kind of sits right in front of the camera, and then I've got others, to the right and the left that I pull things from. So don't think I'm watching TV or checking my email or something. All right, so let's review this. Financial planning topics, pros and cons of Roth IRAs. Are there cons of whether you're contributing to a Roth IRA or converting to a Roth IRA? So the contribution, just to be clear on this, a contribution is, again, we're focusing on IRAs here. A contribution is when you take funds from your earnings. You have to have earned income to contribute to a Roth IRA. You take funds from your earnings, and if you're under certain thresholds, you can contribute to a Roth IRA. If you're under 50 years old, that is $6,000 a year. If you're over 50 years old, that is $7,000 a year. The other way to get money into a Roth IRA is by converting. And I just said a few minutes ago that there are no limits on income. You can earn $1 million, $5 million a year, and you can do a conversion. As long as you have funds in a tax-deferred IRA, you can convert. And yes, you can do, for a contribution, you can do what's called a backdoor IRA. We talk about that. That is on the chopping block, as we know, with the tax code changes. But right now, you can do that. So you can do that backdoor IRA or Roth IRA contribution. It's complex, so I'll talk to you about that offline if you wish. But you can contribute $6,000 a year if you're under 50, $7,000 a year if you're over 50. We did get the updates for next year. I don't have a chart yet for you, but that hasn't changed for 2022. It'll still be $6,000, $7,000. So if that makes sense, or if you're considering that, what are some of the cons? Well, you have this 5-year rule. So let's first look at the 5-year rule. And I'm going to just check these as we go along. So the 5-year rule. The 5-year rule says that if you're under 59 and a half, you have to wait five years, and you have to be over 59 and a half to distribute any earnings before those earnings are tax-free and not subject to 10% excise tax if you're under 59 and a half. Remember, there's a big difference here. We have less than 59 and a half and greater than 59 and a half. If you're under 59 and a half, yes, it's very challenging, right? You have a new period for each one of the conversions. It gets to be very challenging. If you're over 59 and a half, it's very simple. Everything's combined, everything's an aggregate, as we talked about. So if you've had any Roth IRA for more than 5 years, then you've overcome the 5-year rule. Now, here's the chart I was talking to you about that we have. So the Slott Group put this together, and this is designed, I've shown you this before, but this is designed to make the 5-year rule simpler. And I think there's no way else to do it because it can be confusing. But my goodness, there's nothing simple about this chart, right? And they talk about the clock begins, the light bulb goes on. No, that's something else. The clock begins, clocks, for each one of these things. But just remember this. And if you want a copy of this chart, I can send it to you. Just send me an email. It should be. I will upload this onto the website so you can access it if you'd like. But right now it's not, but I can send it to you. But here's the thing. So
if I'm going to go back over here because that'll just hurt your eyes over time. If you're over 59 and a half, again, it's really simple. If you've had a Roth IRA for more than 5 years, you're fine. If for some reason you have to take money out before the 5 years, there are ordering rules, and we talked about that. So if this would really be if your back's against the wall, right? So first, let's say you have $100,000 in a Roth IRA, and you've done contributions of $50,000. Well, the IRS says, well, first those contributions come back to you, right? You've already paid tax on those funds. First, those contributions. Then let's say you've done $30,000 worth of conversions, and you want to take the whole 100,000 out. So 50,000 comes back to you first. Ordering rules is contributions. Second are conversions, right? So $30,000 comes back. So the only thing that would be subject to either tax if you're over 59 and a half, or tax and a penalty if you're under 59 and a half, would be the $20,000. That would be the last part. So you could really leave that last bit in there. But the problem with so I've never run into this because most people understand we carve out exactly how much people are going to need. You know, all of this should be done in a financial planning discussion, right? Any kind of conversions shouldn't be done without considering everything. And that's why we talk about the pros and cons. But I forget what I was going to say there, but I'll come back to it because it escaped me. But don't get too caught up on the 5-year rule, especially if you're over 59 and a half. Well, the other con is you got to pay tax now. So whether you're doing a Roth conversion or you're doing a Roth contribution, you have to pay that tax now. You need to fund that from somewhere. If you're even if you're doing, I'll just skip into the Roth 401k for a second. Even if you're changing your strategy to fund your Roth 401k this year, if you're over 50, it's $26,000 a year. Next year, it's going to be $27,000 a year. You're going to have less money in your paycheck. That is just how it goes because you're no longer getting that. You're paying tax on that money before it goes into the Roth. That's the deal. You have to pay tax now. So you have to have a strategy for that. If you're over 59 and a half, you're either going to pay it from your taxable investments, right? You get your taxable, tax deferred, tax free, or if you're, or you can withhold it from your IRA. And that again the best way to do it can only be determined by good financial planning and working all these questions out. How about cash flow? Well, because you have to pay tax now, you're going to have less money to spend now. More money is going out to pay the tax, so that you have the benefits later, but it certainly means you're going to spend more now. So we significantly increase the spend in the beginning of retirees' lives because we're paying this tax. Again, you have to make sure that makes sense. You may give up some tax credits because it increases your modified adjusted gross income, your taxable income, things like IRMA, income-related monthly adjustment amounts. When you're over 65 years old and you start on not Social Security, excuse me, Medicare, there is an income-related monthly adjustment amount that can be very significant. You have to determine if it makes sense, because if you're doing Roth contributions, let's just say you're still working and doing Roth contributions and it raises your income, well then because you're not getting your tax deduction on that income, then it could raise your IRMA, income-related monthly adjustment amounts. Now remember, I'm just going to pull this down here. This is from my website. You can, if you want to see what I'm talking about, you can go here and you can see where that gray table go. Right here, these are the IRMAs, right? If you go for a single filer from 88,000 to 111,000, and it's not gradual. As soon as you cross over that, you pay this extra surcharge for Plan B, and Plan D can be a total of $71.70 per month per individual. So as a husband and wife, you're both paying that. You can see if you push it all the way up here, we often lived in the $329,000 tax bracket area. Well, that takes people to a total of $288 more a month, right? And remember that it's time too. So you can look at this table and see if it makes sense. Now, one of the things that we do is we run a spreadsheet for folks that shows side by side these IRMAs, right? Whether you pay it for the rest of your life or you pay it for a short period of time in your when the time that you're doing Roth conversions and whatnot. And I've never seen a time when it hasn't been a significant savings on IRMA by doing the Roth conversions, but it may be different for you. So you've got to work through it with financial planning. Let me just pause for we're going to go over the 45 minutes here. I hope that's okay. Walter, do you have an opinion on using low interest debt to help finance Roth conversions? Oh, Walter, I worry. So Walter's asking about using debt. So he's talking about cash out home refinance to pay tax. I am always reluctant to add debt especially for something like this. But I guess as long as you understand the risk, it's something to consider. I wouldn't want to dismiss it out of hand. Generally, you're not going to be surprised to hear me say it's an individual question. Many people, as they're entering retirement, one of their plans is to sell their home, within the next 5 or 10 years. So if you're taking debt out of your home, for example, to pay for something like tax, you may have to pay that back. Now, there's a really strong reverse mortgage strategy if it's the home you're going to stay in to help do things like that. So that's something to consider. That's actually tax-free distribution, but there's a lot of different things. And I have a video. I actually don't think that one's on the website. I'll have to put it up there, but that talks about reverse mortgages. Okay, the next thing in this list, Social Security tax. While you're paying tax on Roth conversions, or you have a higher level of income because you're contributing to a Roth IRA and you're collecting Social Security, you could be subject to Social Security tax. So again, you've got to consider that. It has to be done much earlier. A conversion has to be done much earlier. You have 12/31. Remember, the conversion has to be done by 12/31, not 4/15. Roth contribution can be done by the tax filing deadline, but not the conversion. So pay attention. Another reason. So the con here would be confusing deadlines. I wish everything could be done by 4/15. The last thing is charities. This occurs often. Again, when you go through proper financial planning, you find out that, hey, this is what I'm likely to spend during my lifetime. This is what I'm likely not to spend. If you don't have children, where's that going? If you do have children and you want a certain amount to go to them, or you're doing maybe a family charitable trust, that's a very common thing these days. If this is going to go to a qualified charity, and you determine that you have $100 million, that'd be exciting. $1 million, that is going to go to charity at the end of your life. As an example, I know this is terrible. I'm writing while it's up. If it's going to go to charity at the end of your life, well, you wouldn't want to pay tax on that now via Roth conversion, because it goes to charity tax-free. And you could also do QCDs, qualified charitable distribution. So there's a lot of strategies you can use. So if you determine an amount that at the end of your life is going to go to charity, consider not converting that. I would say don't convert that, right? I would give you a hard line recommendation on that, because you'd be paying tax on something that never has to be paid tax. All right, let's go to pros. Well, the first pro is the same as the first con. You pay tax now. You pay tax now at the rate that we know what taxes are, not the I don't know tax rate, right? So would you rather know what your tax is going to be? I'm going to go up to the 22% tax bracket on this conversions. My effective tax rate is going to be 18%. Therefore, a $100,000 conversion is going to cost me $18,000. I'm never going to pay tax on that $100,000 again. I've paid my $18,000. Or the I don't know tax rate, right? That's what we're looking at in the future. I don't know what that tax rate's going to be. And we all know it's likely to be much higher than it is today. So I think of it this way. I filled up my Jeep the other day, last week, I guess it was. I'm still not driving a whole lot, but it was significantly higher than it was last year, right? So gas is, I buy it at Costco, it's $3.50, let's just say a gallon. A year ago, it was still $1.89 or just less than $2. If I could have bought all the gas I'm going to use for the rest of my life at $1.89, wouldn't that be the smart move? Yeah, the answer is yes. That's exactly what you're doing with a Roth conversion. You're buying all the liquidity of your funds now, right? Because you're paying the tax at the rate that you know. And you understand the ownership of your IRA because it's in a Roth. You're never going to pay tax again for the future. So it's just like if I said, well, you know, I use 20 gallons a week in tax and I multiply that until I'm age whatever, and I have a reserve of that at $1.85 a gallon, you know, I would have done that all day long last year. So that's what we're doing now. If we know the taxes are going to be the lowest they're ever going to be in our lifetime, why wouldn't you do that? So that's a pro, pay tax now. The other pro is cash flow, same as the second con, cash flow, potentially more money in retirement later years. Well, you pay the tax now, you have more money going out. That example, that $18,000 going out to pay that. So that's less money you have now. But as that builds, so that growth is happening in a tax-free environment for the future, and whatever you pull out is going to be tax-free, and you'll know exactly. If you have to pull out $70,000 a year, that's a real $70,000. And if you have $1.5 million in a traditional IRA and you have $1.2 million in a Roth IRA, which one do you think is more valuable? I will tell you all day long, the $1.2 million is more valuable. Because that $1.2 million is going to be yours to spend. The 1.5, you don't know what that spendable amount is going to be. It could be 1.2. It could be 800,000. We just don't know because we don't know what the tax rate's going to be. Your partnership with the IRS, remember that, you know, partnership with the IRS or the Congress, which is worse. In the future, in your retirement, they can say at any time how much you owe them. So potentially more money in retirement in later years. More money to heirs. If that's one of your goals, more money to your heirs. You eliminate income tax on distributions. Remember, excuse me, it's always going to be part of your gross estate. So any estate tax or inheritance tax is going to be calculated in that. But income tax will be completely eliminated. Yes, they'll have to distribute it under the current rules in 10 years, in at least 10 years. You're eliminating income tax on distribution. More money. It's a gift to you. It's a gift to your heirs. Flexibility is another big pro. No RMDs, no required minimum distributions for you while you're here, right? And now no required minimum distributions for your heirs except for that 10-year rule. So, but you remember in the one letter, the person said, I have to take $70,000 this year. Well, he clearly doesn't need the $70,000 because he wants to send $50,000 of it directly to a charity via the qualified charitable distribution. But he has no choice. He has to take that distribution. With a Roth, with Roth IRAs, there are no RMDs. I'll step into Roth 401ks as an example of the differences. A Roth 401k, if you are over 72 years old and not still working or not more than a 5% owner of the company, you must take an RMD out of your Roth 401k. So that's a big difference between Roth IRAs and Roth 401ks. All right, folks, that is pros and cons for this week. I'm sure there's others. This is what I came up with as I was working through this. I think these are a really good starting point. And it is important to look at both sides of it. So that is pros and cons of Roth, using a Roth IRA, converting or contributing to a Roth IRA. So I'm just looking up here. I don't see any questions. We did go just a couple minutes over than what I'd like to. We are allotted for an hour, but I'd like to do 45 minutes. Again, welcome to all of you who it's your first time on this webinar. If any of you need to schedule time on my calendar, it'll populate at the end of this. If you are an existing client, you already have an appointment scheduled, please don't use that calendar. We have work we're doing for you in the background. If you are, of course, a client and you're not scheduled and you need to see us, well, you can call us at any time. Send us an email, jump on that calendar. That's fine. Other than that, folks, Have a great day. Have a great week, and we'll see you next Tuesday. Take care.
Hello again. I hope you enjoyed the video and perhaps you learned something new that can help you. If you want to schedule time for me for a no cost, no obligation consultation, you can use the link in the description and schedule a time that works best for you. If my schedule is full and you can't find anything, don't worry. Send us an email and we'll find a time that works for you. I look forward to speaking with you soon. Thank you. Have a great day.